product is one of a very famous product in Zurich and also in the market. Okay, and this product, is do a lot, means they can make a lot of a difference to the family and also to the life assurance itself, right? So yeah, before delay, let's go. Thank you. Thank for your response. On and off, actually, we need the response because this is online session. Yeah, before and just mute everyone first. All right. So now let's see some of the financial challenge in Malaysia. Okay. First of all, is 60% of Malaysians actually they have less than 6 months in the event of a loss, 6 month income in the event of loss of income. So this actually required the high protection gap. Some more recently actually some of the studies mentioned the retirement fund not enough lah. All this actually is mega alarming to the Malaysian. Alright. And second actually is a housing loan also is dominate the Malaysian household debt. Average size of a housing loan approved from 180 to 420. Okay, so I think majority of people's money actually they go means allocate for the house installment. So therefore, in short, the Malaysian need a high protection to cater for the different needs, right? Next, living a legacy actually has become a very heavy price to pay. Okay, so this actually is a short means news about the living a legacy. But to cut it short, actually is if you want to leave a legacy without the proper planning, actually have to pay the heavy price for it. So it's good to create a wealth for the next generation with Zurich, okay, with Zurich Value Life Premium. Okay, so why actually is so special about this Zurich Value Life Premium? Okay, first, it provides the high coverage up to the age 100 with a high non-medical limit as high as a 5 mil. Okay, previous means last year is still the non-medical limit just touched to the 4 million, but now the good news is company have a bring from the 4 million to the 5 million on the non-medical limit. So that actually is a plus point about this. And secondly, originally on this Value Life Premium, the TPD benefit is until 8 million and now also is enhanced it to the 10 million for the TPD. This one is excluded the TPD income. TPD income is calculated separately. And third is a supplementary TPD income for the 10 years. So on top of the TPD payment, okay, let's say the customer purchase 1 million. So besides they will receive the 1 million, they also will receive the TPD income for the next 10 years on top of this 1 million. And some more, it also provides the life protections up to 500% of the current sum assured. So what is this current sum assured? Later on we will share with you what is this, what does it mean, and how to qualify for this 500% of the current sum assured. We also will share to you more deeper later on, right? So, and at the same time, they also have this additional 25,000, okay, additional sum assured for every 5 years up to 100,000, okay, or after 20 years means they will get the extra 100,000 coverage, all right. So together with a no lapse guaranteed for the first 5 years, and last actually, they have a choice to choose either for 5 pay, for 10 pay, for 20 pay, or even full term. So that actually is more flexibility for the customer, right? So now, next, the different premium payment term and the allocation to cater your needs. So on this Value Life Premium, they have a different term. For those term 20 years and above, this one actually will be the allocation rate. So even in the first year, already got the 60% already. That one is considered quite high. And after 10 years, they will go for the 100%. For 10 pay, so this will be the allocation rate 75, 75, 85, 85, 90, 90, and the 7 year onward actually is 100% already. Okay, while for the 5 pay is 86, 86, 88, and 90 and 100%. So if a customer want to boost the investment in their fund, so they always can choose the regular top up is our max level, or irregular top up is our M top. Okay, that actually they can provide a higher allocation rate for the shorter term to boost your investment account value lah. Okay, that is in short how the Zurich Value Life Premium can work for the customer. So different coverage term also can cater for the different need for the customer. For instance, if they have this housing loan for 20 years, so they can opt for the debt cancellation, which is choose a 20 years term. Okay, and the second option, they can cover up to the age 70. Okay, so this one actually can use for the income protection if a customer wish to do so. And option 3 is this coverage term can up to the age 80. So, and for this option 3 and option 4, we can use it as a legacy planning. So means customer they have a more choice and more options to cater their financial need. That actually is something extra on this flexible term. So now we just highlight the what is the main part about the Zurich Value Life Premium first. So next, on the overseas accidental death, so that one actually will cover 400% of a basic current sum assured, and we will share later. But here the highlight is for those who are traveling to the especially those who are staying in JB okay, and travel to Singapore and work. So, and there is no subject to the 90 days limitation, okay, vice versa. So either they go, Malaysian go to Singapore, or Singapore go to Malaysian. So this both way actually is means not subject to the 90-day clause. Okay, so what is the 90-day clause? When come to this accidental death benefit, okay, part actually we will share more. And for Zurich Value Life Premium, this one actually is just for our internal, means for our internal consumption only lah. We know that to get the case means to get the deal come is not easy. So to ease on this underwriting process, so we actually company have initiated that for those customer they have a substandard life up to 100% of extra mortality. Okay, so this percentage how to determine is not by you, by me, actually is by underwriter. So if the substandard is up to 100% EM, we call the extra mortality. So underwriter will accept it as a standard life. Means they have a 0% medical loading imposed. So that will bring the good news to the customer, and that actually is the underwriting side will do so So, but for our knowledge actually is this is a plus point because for the customer actually there's 100%. If those customer they have 100% loading, sometimes actually has for the BAU, business as usual, that this actually the company will issue the counter offer. But if this is happen to the Zurich Value Life Premium, so they will accept it as a standard life, right? So in short, the privilege program actually will ease your underwriting process and business, right? So that one actually is the good news for you, and we no need to highlight too much to the customer because this one is an internal process, but this one actually is good for us to know right? Secondly, on this auto extension, this auto extension actually start from the 2019 is about 7 years ago. Okay, when the means the whole industry actually have this sustainability. Okay, as required by the Bank Negara, we need to highlight on the sustainability of the policy to the customer. Therefore, only come out with a Zurich Value Life. Okay, start from the Zurich Value Life Premium. So we start on this measurement on the sustainability requirement right? So for the sustainability that's why actually we have this 20 years term, 70 cover up to 70, 80 and 100. Okay, and for the customer, like example, the age 25, okay, I only can afford for 20 years. Okay, so for this case, after 20 years, is it will be another concern is what will the policy will auto extend or not? Okay, the answer is yes with this auto extension clause. That's why if after that, if I got the times, I also will share with you one quotation, okay, for us to really understand, okay, what is this about, and to make us understand the quotation and also easy to explain to the customer. Right. So for the age 45, it can afford up to the age 100. That one is no issue. But for this auto extension is only applicable for the 20 years term, 70 and 80. And the policy actually when come to the, we call the expiry of an initial term, okay, means is for instance, they choose a 20 years. After 20 years, okay, like this guy, 25, after 20 years, which is age 45. So what happened to the policy? If this guy, he still want to continue the protections, the policy will auto extend to the age 100. Okay, this one actually will support the customer in affording in the long-term life insurance, and so we have this auto extension of a coverage term. Okay, and in the quotation also have a two set of a premium. Okay, so sometimes the premium will be the same, sometimes actually will be different. So depend on the age and also the term they choose. So auto extension will be allowed the coverage term auto extend to the age 100. And if all rider attached also be extended accordingly, right? So if the fund value cannot sustain, okay, the policy up to the age 100, so customer will be notified minimum premium commitment required to sustain up to the age 100 . But anyhow, on this sustainability, we no need to be worried, because every year, okay, beginning of a year, for the customer, actually they will receive the one letter we call the ILP sustainability statement. Okay, and that segment actually will tell the customer how long the policy can sustain, okay, with the current premium they paid, and if they want to go for the 100 years old, how much is the premium required. Okay, if some of you actually, if want to customize to the customer, you even can go to the iAdvisor and use the one policy calculator and do the sustainability test for the customer. Right? Now, let us continue on this part. And customer will be notified at least 3 months before the date of extension. If a customer does not want their coverage to be auto-extended, they can inform us with a notification period. So this one is nothing right and wrong. Even sometimes your customer say, hey, if I just want to pay my current premium, so during the auto extensions term, okay, can I do so? The answer is also can, but that one will be subject to how the tenure, or we call the sustainability period, actually be shorter we pay the current premium, but that one also is depend on the situation. So this one is an auto extension of a coverage term, right? So because today we have this thorough Zurich Value Life Premier training, so that is good for us to highlight to you what is this mean, because for this auto extension, it's not only apply for the Value Life Premier. For others plans such as a Value Life Plus, they also have this auto extension clause, as long as there is a investment policy, except for max invest the single premium. Okay, that one actually they don't have the auto extension clause. So what is this auto extension clause refer to is if the life assured survive to the maturity or expiry date as stated in the policy information page, so the basic policy will extended after maturity date. This one actually is refer to the initial term, which they choose a 20 years up to 70 or 80. But if up to 100, no need already, okay, because the auto extension will allow the policy sustain until age 100 without evidence of the insurability. Okay, that is the most important, because some customer worry about it. If kalau saya ada health problem, so what happened? So the answer is no need to be worried, because for the auto extension, they will auto extend without the evidence of insurability. So any investment account value, all this actually will carry forward upon the extension. Okay, even the supplementary contract means is a rider lah. The rider which are still in force also be auto extend accordingly to the respective maximum term available, right? But anyhow, for the Zurich Value Life Premier, they don't have so much of a rider to be attached. So the most is the CI, Critical Care Essential, level of premium. Okay, so these are the some of the basic rider lah. Okay, and to ensure the investment account value has sufficient amount to deduct all the relevant charge and fee during the extension, so the additional premium may be required. So that one is how the customer can know, through the annual sustainability statement they receive every year, or even we can through the one policy calculator we can do for them, right? Now, go back to this hero power on the Zurich Value Life Premier. First, the most very conducive part, okay, for us to sell to the customer and can highlight to them is we have a high non-medical limit up to 5 million. Okay, so that actually is a very high non-medical limit for the customer. Okay, or means for those, but subject to the age. The age factor. The age is later on I will share with you that the age range, the 5 million one, and the coverage to the 10 million sum assured for the TPD. That one also is another plus point. Okay, 10 million is a lot. Now, we no longer talk about 1 million, 2 million. Now TPD actually can go to as high as 10 million, and some more. In addition to this, we also have a supplementary TPD income for 10 years. This is a 5% every year for the next 5 years, for the next 10 years. And fourth point is an infectious disease benefit for the hand, foot, mouth disease, Zika virus, and more, right? So now, addition to this is the life protection up to 500% current sum assured. What this is about, later on we share. And the additional sum assured of 25,000 every year up to the 100,000, and no less guaranteed, together with flexibility premium term. Okay, for 5 pay, 10 pay, 20 pay, or even full pay. So that's why you see for this plan, for the coverage term, customer can choose 20 pay, 20 years up to age 70, 80, or even 100. When come to the premium, they also can choose for 5 pay, 10 pay, 20 pay, or full pay. So that will provide a lot of flexibility for the customer to choose according to their financial needs, right? So now, let us have a look on the hero in the premium on the for this ILP market. So the minimum entry age, so as low as 30 days actually can purchase on this plan already. So this plan actually can from 30 days to the 70 years old. So it's a very huge market for us to tap into. Okay. In addition to this, we also have an additional sum assured, which is every 5 years we have an increase of 25,000 basic sum assured. Okay, for the customer. So that is sometimes in short name we call the ASA additional sum assured. ASA plus a basic sum assured become the current sum assured, or we call the CSA. And some more we have an accidental benefit up to 5 times. And this one actually now with the first start from the 1st of January 2026 for the accidental death benefit, okay, the maximum payout will be 15 million. Okay, I repeat one more time, will be 15 million or 15, 15 juta. So it's quite high also. And supplementary TPD income, kita ada as compared others, they don't have a supplementary TPD income. And also we have this infectious disease benefit and annual dividend. Yeah, annual dividend, even though actually it's not so significant, but in this plan, we still have because for the annual dividend, they will pay out in every year or in the month of March. Okay, they're subject to the account value. Last actually is the TPD limit. So we have a 10 million TPD limit. So this also is a plus point about our hero plan, right? So for the value life premium, now let us zoom into the technical part about this value life premium, right? Yeah.
Segment here. Just now you're talking about the accidental death benefit, huh?
Uh-huh.
Let's say somebody is taking 5 million, supposed to be 5 times 25, now reduced to 15, is it?
What you
Accident,
miss
just now the previous page.
Okay, wait
Supposed to be
previous
25,
page.
right? 5 times means
This
why
which one?
15 million? You're talking about the accidental
Yeah,
benefit.
they will cap at the 15 million already. Start from the
It's a
1st of
cap already, is
January.
it?
They have a cap
Oh, just
already.
earlier, no more, no, huh?
Earlier, no. Earlier actually is a no cap, but now start from the 1st January 2026 for the accidental death benefit. Okay, so we cap at 50 million. Okay, can
All right, okay.
All right, can. Thank you. Yes. In
Maybe
the
starting from 1st January, huh?
quotation, start from the 1st of January, but you can check on the contract. Mm. Oh, I see. So I think the contract in the IZLEC actually they have this contract. Even even I think in the quotation, not quotation, the secular also have highlighted that. So we have a secular on the enhancement of the Zurich Value Life Premier. Over there, I also have a mention about this lah. Let me share. Okay, but anyhow, this one, don't worry. The all this actually is clearly spelled out in the circular. If you want later on, actually I will share with you lah. Okay, quotation they might don't have this so detail because of because of this they have they just highlight the main point only lah. Okay, not all. Right. So now since actually some of you have talking about this, think it's good for me to highlight. Just wait a minute. Okay, share to all on this. Jump through a bit. This one actually, if you want to know more, actually you can go to the iAdvisor and check on this circular start from the 1st of January. Okay, so and later on I also will highlight to you lah. Okay, what is the enhancement happen here is an improved underwriting rules, which is from the 4 millions to 5 millions for the age 16 to the age 50, right? And the 51 to 60 is from the current 1.5 mil, actually now it's go to the 2 million. Okay, so that actually is make the value life premium more competitive and convenient, right? And next is about the simplified financial underwriting. So before 1st of January, actually they break it down to the professional and non-professional. But now with the new changes or new update, actually they are not categorized on the professional or non-professional anymore. All actually is combined into the one category, which the non-financial underwriting limit actually is extend to the 4 mil, even for non-professional. Okay, but for 4 million, 1 ringgit to 6 million, subject to LAQ and more than 6 million is LAQ and the proof of income document, right? So increase on the TPD limit, okay, before 1st of January is 8 million. So that's why today actually we highlight is the start from the 1st of January is the 10 million already, right? Last actually is the update on the accidental death benefit. Okay, prior to the 1st of January is no limit per life, but now actually we have a cap on the 15 million, right? So for Mr. Skaran and just now who is asking, so you want to know the detail, can go to the iAdvisor and download the circular on this Zurich Value Life Premier product update, which is happen on the 1st of January 2026.
So the cap will be only for the new policies, not for the old policies, sir?
Yeah, for the new policy, Mr. Skaran.
All right, thank you.
Okay, can. Okay, shall we continue? right? I think it's a very interesting part. Many of you actually are very keen, especially those of you who have sold this plan before. So this one actually is a very important update for us to know. Okay. Okay, so that also we take this opportunity on this value life premier training to highlight to all on what is the main changes. Right. So, but those actually are first comer. Yeah. So it's good for us to know also. Okay. Next, let us move on to the key benefit of the Zurich Value Life Premier and what does this Zurich Value Life Premier can bring the benefit to the customer, right? So for the Zurich Value Life Premier, this plan actually is the regular premium investment plan that provide the protections, okay, and also saving for the customer. Okay, so this plan actually, in short, they have a protections come the saving, okay, up to the age 100. And at the same time, they also provide the accidental death coverage up to 500%. Okay, so how this is just a summary first. So for the all causes is 100%. For balik kampung is 200%. Okay, on the accidental death or TPD. And for the public convenience accidental death is 300%. Okay, while for the overseas accidental death is 400%. For those on board flight is 500%. Right. At the same time, they have provided the supplementary TPD income, which is 5% of current sum assured for the 10 years. And this supplementary TPD income is paid on top of a lump sum TPD benefit, which, for example, if they purchase 1 million, after paying out 1 million, they still can receive the 50,000 every year for the next 10 years, right? Subject to the maximum, just now we say is that one actually is 10 million for the TPD benefit, right? So infectious disease, we got this 14 infectious disease cover and also the additional 25,000 every 5 years up to 100,000 and also got the knowledge benefit. So other than that, so we also have this annual dividend, which is 0.15% per annum, okay, of the daily average fund value starting from the first year, and also lower protection cost because we are based on the sum at risk, okay, and that one actually will provide the lower cost protections for the customer, okay, is especially if they have a high cash value and also we provide the multiple gateway to the local and foreign hedge fund, okay. And we know that coming soon.
Mr. Yap,
yeah.
sorry, Mr. Yap, please, just now the slide before this, one more time.
Which one?
No, slide before this.
Oh, this one.
Yeah, thank you.
Okay. Right, so far so good, huh?
Yeah, good.
Yeah, Mr. Yap, this slide one we can download from iAdvisor or you will.
iAdvisor ada. iAdvisor in the training catalog ada.
Thank you.
Okay.
But just now the slide, people got to be very, very careful. If you're selling 20-year term, that means the increase every 5 years was only 3 times. The fourth, when it comes to 20th year, the policy mature. That means it's no more 100,000. It's only 75. It's already stated there. You got to be very, very careful.
For 20 years lah.
Yeah.
But
It's
for
only
the quotation,
75.
for the quotation wise, later on I will share your quotation for the example okay, for us to know. Thank you for highlighting.
Please, yeah.
Right.
Quotation is that's the best way we can address with the customer. Quotation. Later you address with the quotation. Thank you.
So definitely actually later on actually I will share on the quotation. But now let us go through the key feature first, okay, before we go through on the quotation. Okay, all right. Okay. All right, so next, this one actually is just a recap on the previous one. Okay, next, let's see on this flexibility of a coverage term for the value life premium. So they provide the 20 years term up to 70, 80, and 800 So this one always depend on the customer need. As we mentioned just now, if for example, for those actually they have a housing loan for 20 years, they might choose for the 20 years term. Okay, for those they would like to have income protections, okay, so they can choose up to the age 70. And for those who would like to leave a legacy for their loved one, so they can choose up to the age 100 or even 100 years old, right? So this one actually is in term of a coverage term. So means one, sometimes actually I will receive the call from the leader. He say, hey, Mr. Yap, why actually some of the term we cannot choose. Coverage term we cannot choose. Those actually also depend on their age also. Okay, and when come to the underwriting, means the entry age on the means each term. Okay, we will share with you further in the more detail, right? So for the flexibility of a payment term, okay, this one is talk about the payment term. Payment term we have a 5 pay, 10 pay, 20 pay, and full pay. Okay. So for 5 pay, 10 pay, and 20 pay, the minimum premium required for monthly is 250 ringgit. Okay, while for the 2 pay actually can as low as 200 ringgit per month. So that actually is a main difference, okay, to highlight to all. So talk about the additional sum assured. Yeah. So for the additional sum assured at the end of for the 5 policy years interval, means after 5 years, they will add the 25,000, okay, without the additional insurance charge. Means, for instance, if let's say they purchase, okay, we just put an example here. If normally we put the minimum, how much the minimum sum assured of this plan? Just to test everyone. Berapa minimum sum assured? $500,000, madam, thank you. So minimum is $500,000. Okay, 250 is for the campaign only. For the certain campaign, actually they will drop to the 250, but standard means other than the campaign period, all actually is $500,000. So for instance, if let's say the customer purchase $500,000, 500,000, after 5 years, this plan actually the coverage will become $500,000 plus 25K. So it will become the 525,000. Okay. So that actually is what we call as a CSA. CSA is a refer to the current sum assured. Okay. How does the CSA compute? Is a BSA. BSA refer to the basic sum assured. Okay. And the 25,000 is the additional sum assured. Okay. So for the basic sum assured 500,000 plus the additional sum assured 25,000. So the current sum assured will be 525,000 at 5 years. This one is 5 years. So if the policy term reach to the 10 years, so the 525,000 will become 550K. When reach to the 15 years, they will add another 25. Okay. And until the 20 year, so the total will be the 600,000 already. Okay. So this additional 25,000 is per policy. Okay. It's not per sum assured or what. That's why it's important for us to know how this current sum assured derived. Is a basic sum assured plus the additional sum assured. And what is the conditions, okay, to increase on this 25,000? The condition is the policy must continually in force for the past 5 policy year. Okay, that will be the condition on that. Okay? And for the 20 years,
Sorry, Saravanan. So if after the 20 years they will auto extension, right? So what will happen with this policy? Is it that they maintain until the maximum, this one, the additional 20%? What will happen?
Okay, so if auto extension, they will continue on this 600,000 for the protection.
Okay, Roger. Thank you.
Okay, Saravanan. Then Right. So now let us move on. For the 20 years term, the additional sum assured will be kept at 75 means because until 20 years already have matured. Okay. So this benefit shall cease immediately upon the claim under the policy. In the event of a late notification of the claim and accumulated additional sum assured is increased right before the notification of claim, so the accumulated additional sum assured will be adjusted upon the claim payment. So there, that one actually is on the additional sum assured. Now, we are moving on to the death benefit and TBD. So on this value life premium, okay, we need to know the death benefit actually they will pay whichever higher. Okay, whichever higher is means what? The death benefit actually they will pay on the current sum assured. Okay, this one is to make us know either the current sum assured or the investment account value, IAV, okay, after minus off the 12 months withdrawal everything. So this one we will pay either one. If a current sum assured high, so we will pay current sum assured. If an investment account value is high, so we will pay the investment account value. So to highlight this one, actually here got the two example for us to look through. First, for the example A, let's say if the current sum assured is 1 juta, 1 million, and the investment account value is 800,000. This one is extreme case The normal case actually would not go for so high Okay, so this is just for our understanding only. So we can see in this situation, okay, in this situation, the benefit payout on this example A1 is a 1 mil. Why? Because the current sum assured 1 mil This one 800,000 ini lebih tinggi, so we pay 1 juta And the example A2, investment account value 1.2 juta. And the current sum assured is 1 million. Therefore, we will pay 1.2 million on this part. Okay. So this one example A is without any withdrawal, okay, without any partial withdrawal. Now, let us move on to the next. If let's say the customer have performed the withdrawal as high as 300,000, okay, ini 300,000 the other buat pengeluaran separa, okay, partial withdrawal. So for that case, actually we need to minus off How? We quote the example here Investment account value before withdrawal is 1.2 mil. Current sum assured before withdrawal is 1 mil. Okay. So how to get the actual amount is we need to, if we follow this formula, 100% sum assured minus 100% withdrawal for the past 12 months. In the past 12 months. So here is a 1.2 mil minus 300,000 will be 900K. Okay. So the cash means the current sum assured is 1 mil minus 300,000 will be 700K. So in this case, also we will pay the account value only investment account value after withdrawal, which is 900,000. Okay, so in that case, the death benefit payout will be 900,000, and the TBD is until 70 coverage, right? So now, let us move to the balik kampung accidental death benefit. So we know that for the balik kampung accidental death benefit actually can claim as high as 200%. Okay, so the criteria to qualify for the balik kampung, actually they have 3 main criteria First, this one must be happen in the Malaysian national public holiday which involve in every stage. Semua negeri kena holiday like recently the Thaipusam and also federal the federal day that one actually is just on the federal only, so that's why it's not considered the national public holiday event involved in every stage. Okay, so the example is a Merdeka Day, all this actually is considered all right. So and next actually is they must have pay at any toll express highway which is registered under Lembaga Leboraya Malaysia. So we know that the LLM, you can check in the LLM, the list of the highway is listed in the LLM, Lembaga Leboraya Malaysia. That one actually is the means the highway actually we are covered under this Balik Kampung. And the next TPD is paid, okay, in the event of a TPD before the age 70, okay, and also the death of TPD must occur within 365 days from the accident. So these are the term and conditions in order to claim on this Balik Kampung accidental death and TPD benefit. But here I would like to highlight is normally if we look at our GA, our others plan like multi-shield or others plan that actually they got this means accidental death benefit for the Balik Kampung also. But what is different about the others and here is for Zurich Value Life Premier, we also cover for the Balik Kampung accidental TPD benefit. Means in the event of this event, okay, and cause the customer TPD, so we will pay, okay, that amount also. Okay, now go to the calculation. Okay, before withdrawal, okay, this one is quite straightforward. Let's see, the current sum assured is 500,000. Okay, now this one should be within 5 years, and they have performed the withdrawal 200,000. Now let us look on this before withdrawals first. Before withdrawal, let's say the account value is 900,000. So just 900,000, okay, depend on how much is the account value there. So for the current sum assured, 2 times of current sum assured is 2 times 500,000 is 1 million. Okay, if without withdrawal, before withdrawal, the payout actually will be 1 million for this situation. Okay, but after withdrawal, okay, after withdrawal, 900,000 minus 200,000, after withdrawal, the account value will be 700K. Okay, but for the calculation of 200% of current sum assured, how is the 500K minus the 200,000 withdrawal, because within 12 months, actually they have performed the withdrawal 200,000. So the balance is 300,000. So we use that 300,000 times the 200%. That's why it's how we derive the 600K. So in this situation, actually we will pay 700,000 because 700,000 is higher than 600K. That actually is on the Balik Kampung accidental death or TPD. Okay, when actually, let's say this is the TPD, so if let's say before withdrawal, just to check all understanding, so if they purchase 500,000 and before withdrawal, and company already pay the 1 million, okay, so that actually is 1 million payout under the TPD benefit. So now my next question is how much is the TPD income payable? TPD income based on this scenario before withdrawal. Dia sudah terima 1 juta.
10% of the pay, sum assured, 1 million times
5% of
1 million.
5% of original current sum assured. Ini tak ada darab. How much is the sum assured? Current sum assured?
500,000.
500,000, yeah. So it's 5% of the 500,000 of 500K. So they will receive the 25. This one is the 25,000 every year. Okay. So the TPD income tanda darab 2, we based on the original current sum assured. This one is already times 2. Okay. But total benefit they get is 1 million plus this 250,000, because they will receive for 10 years. Okay. So that actually is an example to highlight to all, okay, to make us understand about this picture. All right. So next, about the public convenience accidental death benefit. Okay, so in this case, actually, we pay 300% now. Okay, what is a public convenience? As long as it's a public convenience commuting in the public, the claim must occur while commuting the public convenience, such as a ferry lah, okay, or bus, train, LRT, MRT. All this actually is considered the public convenience, right? So in this case, is let's say the current sum assured is 600,000. Okay, this assume after 20 years already from 500k become 600k, and before withdrawal, the account value is 1.5 mil. Okay, this one also I need to highlight is the extreme case. Hardly actually we can have an investment account value for 1.5 mil. So for this one is a 1.5 mil. So for the 300% of current sum assured, which is a 600k times 3, so it's a 1.8 mil. So for that case, 1.8 mil is more than 1.5. We will pay out 1.8 mil. If after withdrawal, yeah, this one actually is a 600,000 have to minus 600,000 minus 200k. So the balance is a 400k. So the 400k times 3 is a 1.2 mil. Okay. So in this case, 1.2 mil versus a 1.3, company will pay the 1.3 to the customer. This one is after withdrawal within 12 months. Okay. After 12 months, actually we're back to here again. Okay. Next, on the accidental death benefit. Okay. On the accidental death benefit in overseas, okay, it's a 400%. Okay. So for that case, actually, we don't have a scenario for you to calculate, but it's quite straightforward. Just use the formula just now what we share. Okay. And this one, the term and condition is first, the claim must occur traveling outside of the residing country. Okay. Residing country, like say it's Malaysia. So it's outside Malaysia. And the traveling cannot more than 90 days from the each trip. Means start from the passport shop. Okay, after like say start today okay, today is what date? 4th of February. Okay, cannot more than 90 days, so they can claim on this accidental death already on this overseas accidental death benefit. Okay, but not subject to Singapore. Singapore actually is not, they are not applicable for 90-day clause. So let's say if a customer now in Malaysia and stay at Singapore for 100 days, okay, and 100 days over there accidental death, okay, so we will still pay the 400%. Okay, this one is a Singapore, not subject to that 90-day clause Other than Singapore, like Thailand, Indonesia, or even others country, or actually is the subject to the 90-day clause. This one actually we need to know. And on board flight, accidental death, okay, this one is 500%. The claim must occur on board a commercial aircraft, but it is in the flight, and excluding taking off and touching down of this aircraft, okay, and must occur within 365 days from the accident, right? So on board flight actually is a 500%, means it's atas langit At that time actually we will pay 500%. And now start from the 1st of January, one thing we need to know is the maximum is the how much on the accidental death benefit. I think just now some of you are asking, maximum is
15 million.
15 million. Okay, total is 15 juta. So then this one actually we have to take note on that. So now, that's all about the up to 500% accidental death Right, now let us move on to the next.
I've got one question. I'm Saravnan here. Just a quick one. Because nowadays I really appreciate Zurich because they're having an online portal to submit the claims, rather than talking to a human being. Now we already submit via all the system, right? So when the claim occur, we submit, then we alias with the email, right? Most of the claims we alias with the emails, they send what they query. That claim, accidents claims, which department is handling? Because nowadays it's not easy to talking to a human being. We are talking to the computer. Only email, we're talking email only, So
You
which
mean the
department
claim
is-
inquiry, is it?
Yeah.
Claim-
This mean this regarding the claims hawker. It's very rare we keep in touch with human being. Most of the time we just email, then someone will reply. Not easy, That's the things. Just asking. When the claim hawker, there were so many issues coming up, Thanks. There's a sharing lah. What's happening?
Oh, thank you. Okay, noted on that. For that one, actually, is you send to the claim inquiry or upload the document.
So
Mr.
normally we
Sarah.
upload the documents. Yeah. Normally
Oh.
we upload the documents. Then we got reference number lah. So in additional, but I really appreciate because they really fast. They approve the claims all. It's really fast.
Mhm.
On that part is really appreciate. But when it claims,
Okay.
we say that just now you mentioned that accident occur only for Lembaga when IV, If he
Mhm.
in the normal road that there's no claim payout, right? They got clause, isn't it? So
The normal road actually is don't have a 200%.
That's right. So we are selling the product. I agree. So some
Mhm.
clients they were reading the wordings, So when claims occur, end of the family members say, you said if TPD, this is it. Because we are dealing with the customers, Sometimes we overlook all the things. So some things of what M. Sekar mentioned just now is very useful because we need to understand the protocol as well. What is written? We can't simply give the words to the customers, The family members will
No.
come to us
Yeah.
because most of them we the advisor, we the first person handle everything. Then they will submit the document to Zurich, So it's just the things lah. Normally we submit the portal lah.
Okay. Thank you, Mr. Saravanan. Thank you. All right. Now, let us move on to the next. I think this also is another very plus point about the Zurich Value Life Premier. I think out of so many plans, these are the only plan we have this benefit, which is a supplementary TPD income. Okay. So for the supplementary TPD income, okay, we will pay how much is the 5% of the current sum assured. Okay, 5% of a current sum assured for the next 10 policy year. So the total TPD income receivable will be the 50% of the current sum assured. Okay, like just now, I think I have give an example is 500K. Okay, 500K if it times the 5%, so it will be 25,000. Okay, customer will receive this 25,000 every year until for the next 10 years. So the first TPD income payment is paid on the next policy anniversary. Means, let's say if the policy anniversary fall on the 1st of June, example, so the next payout will be start from the 1st of June every year. Okay, if the life assured death before the completion of the payment of a TPD income, so the remaining TPD income will be paid lump sum after discounting at the prevailing interest. This one actually the company will calculate a lump sum discounted rate and pay to the next of kin or nominee. So the TPD income benefit is only paid in the event of TPD before age of 70 or maturity, whichever is early. So upon payment of TPD, and the policy will terminate entirely. So upon the accidental TPD on the express highway during the public holidays, okay, which is involved in every stage, so the total benefit payable will be the Balik Kampung accidental TPD of 200% current sum assured, plus the supplementary TPD income of 50%. So the max actually will be 250% on the current sum assured for TPD income and TPD, right? So, but here is something is written in the contract. Okay, I think it's good for us to know because here got many senior here. Okay, so for the TPD income, they actually have a clause there. Okay, company also from time to time they will in between these 10 years so company they might ask the customer go and check doctor and see how is the TPD condition. Okay, kalau example if a miracle happen after 5 years already recovered, so the remaining 5 pay punya TPD income actually is not payable right? So that is just to highlight to all. Which is stated in the contract. So next, the infectious disease benefit. Okay, this is 10,000 per infectious disease And each infectious disease is claimable once. And this 10,000 actually is nothing will not impact the current sum assured because this is an individual one. But however, for the infectious disease, actually they have this 90-day waiting period. Kena tunggu 90 hari lah. And the benefit is paid if diagnosed before the age 70 or maturity. If a customer purchase this plan, the life assured means below age 15, so they will cover on the hand, foot, mouth disease, okay, Marshall, and also meningococcal disease, mum, okay, cholera, okay, tuberculosis, and also hepatitis A. But if they purchase after 60, let's say they purchase at the age of 20, so these are the typhoid, fever, Ebola, all this actually they will cover under this disease, okay? But in order to claim this, have to fulfill the definition of this infectious disease, right? So next, on the annual dividend, okay? So for the annual dividend is 0.15% of a daily average investment account value, okay? This is throughout the year up to the 31st of every year will be credited into the investment account. Now is February, so means in the next month will be the closing on this annual dividend calculation. How does this 0.15% calculate? So they will calculate average how much is the investment account value. The higher the investment account value, so the bigger the amount, but normally it's not so significant, okay? But anyhow, this is just an additional benefit for us to know, unless actually they have a quite substantial, okay, account value, so they can see the money, right? Next, the no lapse guaranteed. No lapse guaranteed here. Policy will remain in force for the first 5 policy year, even if the account value is less than 0. This is to ensure the policy actually will be continued for the first 5 years with hassle fee, provided the customer pay the premium promptly and they didn't perform the partial withdrawal and no premium holiday, and any outstanding cost of insurance and policy fee will be deducted from the account value once actually turned to the positive, right? So the previous program, this one actually is just to further elaborate on this previous program. So on this previous program, let's see, this is introduced a previous program. It's starting on the 5th of May. So the maximum sum assured per life for previous program is go for 2 million. So that's why sometimes actually you submit case. This case is a substandard case. For the other plan, actually they might subject to the loading. But in this case, why tada? Because of this previous program, if their MEM, we call the extra mortality, is less than 100% or less, so they will accept it as a standard life. If they add the critical care essential actually is our 50 CI, okay? 50 CI with an additional CI benefit, okay? So if they add the critical care essential, so the extra morbidity, okay, this one actually is a calculation on the morbidity is the chances of diagnosed illness So if less or equal to the 50%, okay, so they will accept it as a standard life, provided the maximum sum assured cannot more than 750,000 for critical care essential, as well as for the critical care premium level, right? So this is some of the example for us to look at, okay? So example on this case is the customer purchase sum assured 500K, overweight, loading, other 100%. So for this case, actually we accept it as the total basic sum assured per life 500K. Previous program, is it eligible? The answer is yes or no? Yes because it's 100% or lesser. So in this case, actually entitled. They don't have a medical loading imposed. Means for this case, they still can enjoy the standard insurance charge, even though they have a overweight and also the medical loading is 100%. So the second this one, the customer A, they buy the second value life premium, 500K, overweight, okay, because of some reason, the medical loading is 150%. So for this case, actually, is are they eligible for this previous program? The answer is no, because it's already more than, this one already more than 100. So therefore, no loading is imposed, okay, on this 150%. So next, if they purchase 2 million sum assured, okay, 2 million sum assured, are they overweight? Are they slip disc? Okay. So here, actually, the medical loading is 75%. Okay. So for this case, okay, under previous program, the answer is no, because it's 500,000 plus 2 million is 2.5 million already. It already exited 2 million. So that actually is not eligible for the previous program, because previous program for value life premium maximum can go is up to 2 million. So for the customer B, this one is a value life premium, okay, with the critical care essential. Okay, if let's say they buy the 2 million, overweight, loading 100%, okay, why in this case is still tada? Oh, sebab this one is a case submitted before lah, okay, think not applicable anymore. So on this case, the value life premium is 2 mil, overweight 100%, and they buy the critical care 500,000, over the morbidity is 50%, both actually eligible. Why? Because in the ngam 2 million, this one is less than 750,000. So they are eligible on that, right? So now, let us move on to some of the key technical information about this value life premium. Okay.
Yep.
First,
yeah. Saravana, yeah, sorry, I'm Siap. This what you're sharing a privilege program is right. So is it when we create a quotation, we submit to the company, then company will underwrite. Then after that the counter offer appears it. After that the counter offer only appear, right, for the substandard case, isn't it? Is it that the procedure?
Yeah, the counter offer actually will appear. The normal procedure, the counter offer will appear to the substandard case. Correct or not, Mr. Sarah?
Yeah.
Okay, but if let's say the customer, their loading is less than 100%, and the sum assured is less than 2 million, so the customer won't receive any counter offer. They will accept it as a standard case.
Oh, if
that actually is a beauty.
If the counter offer come up, in not this case, if features, then is it chances the customer have to pay extra premium, or you have to reduce the sum assured? Is it possible, or how?
So they might impose the additional insurance charge on loading lah. So that is subject to underwriting decision lah.
Okay, thank you. All right. Thank you.
All right. So I think 70 years old can buy this plan, no? Okay. So but anyhow, as I mentioned just now, the early part, okay, this also is subject to the entry age. Okay, if the entry age is, let's say, they want the 100 years old coverage, so the entry age until 70. Okay, but if they choose for the 80 years up to the 80 years, so the life age is until age 60, right? So if they choose for the coverage term until age 70, the maximum entry age is 50, right? So that's actually sometime if you key in, okay, like 20 years, I think no issue lah. Yeah, but sometimes actually if you're age 55, you want to choose for 70 years term, actually tada. Why? Because they are required minimum 20 years term, right? So 55 plus 20 is at least must until 80 only you can choose. Okay, so that actually always they have a 20 years term. Okay, there's a simple calculation. And one thing, if as I mentioned, some of the leader actually called me and said, hey, Mr. Yap, why tak ada limited pay anymore for value life premium? Okay, the answer is mesti ada punya. Okay, only thing actually you have to choose a right coverage term and also the right premium payment term. Okay, that one actually you can choose in the iSelect lah. No, not much issue lah. And next actually will be the code, the product code. I think this product code don't need to be worried. Okay, it's always be there, right? And the sum assured, I think Madam just now also have highlighted. Yeah, it's a 500,000 minimum. Okay, 500,000 actually, if the customer don't have a so previously buy a lot of a small sum assured plan, so maybe this round is a time for us to revisit on his coverage, at least to top up for the 500,000 coverage. Okay, for 500,000 coverage, actually the TBD benefit already additional 250 already. There's something extra. So talk about the basic regular premium. For this plan, full pay, as just now I've mentioned already, monthly is 200, and for limited pay, monthly is 250. So yearly is 3,000 for limited pay. So this limited pay is refer to what? Refer to the 5 pay, 10 pay, and also 20 pay. For full pay, actually is a full term, right? And maximum subject to the underwriting. Layer premium is allowed. Now actually is 120 ringgit. Okay. And the MSVR, 120 also, but the MSVR is maximum 5 times of basic regular premium. M-top is still subject to the 500 ringgit. Payment mode, if they pay annual mode, is a 5 ringgit per month. And the semi-annual, quarterly, and monthly is 6 ringgit per month, right? So the premium allocation just now actually we highlighted, I think I wouldn't highlight again. So for the COI here, the COI is charged on the sum at risk, okay, excluding the additional sum assured, okay, not on the sum assured. So sum at risk, actually the money is risk at least to pay. Let's say if the sum assured is 500,000, the account value got 300,000, so the Zurich only have to bear the 200,000 risk. So that's why the higher the sum assured, actually the lesser the insurance charge we impose, because the COI is based on the sum at risk. But anyhow, if let's say the account value is more than the sum assured already, they still have a charge or not. The charge actually will impose on this supplementary TBD income. Okay, so now try to reinforce on the new limit on the non-medical. Okay, so for the age 16 to 50, the new limit is from 4 million, now it's reached to the 5 million. Okay, age 51 to 60, now also have extended from the 1.5 mil to 3 million. So this is something extra. Okay, and better. So for the non-professional and non-professional already combined. Okay, that one just now actually we have a highlight. I need just a highlight again. 500,000 1 ringgit to 3 million for age up to the 51 to 60 but the 3 million 1 ringgit to 5 million actually is 16 to 50 years old. Okay, this is something extra. TBD, okay, 10 millions excluded the TBD income. Okay, for the accidental death benefit is 50 million. So the rider can be attached for this plan is the payer benefit, critical care premium waiver, and critical care premium level, and also the additional CI. Okay, so this is a sum of the key notes to share. Okay, now I think I will share one more time on the quotation. So this round should be no problem already. Okay, can see the quotation?
Yeah, thank you.
Yeah, okay.
Okay, this one is for the value life premium. Let us have a look. The front part actually is a PDS log. Okay, PDS is a product disclosure sheet about this plan. What is this plan about? Okay, I think the key information mostly actually is there. Okay, like example, what is Zurich value life premium? This is a combination of protection investment, and they will pay the lump sum if the life assured die. Is a TBD or as per provision in the contract. So next TBD, how much actually we will pay higher. This one also we have to discuss already. Balik Kampong, so we pay 200%. Here also have a clearly spelled out, must be accident in the national public holiday and also the toll express highway. Okay, and public convenience actually is the 300%, and also obviously accidental death, so we pay 400%. And here also is clearly spelled out extra for the Singapore. It travels to Singapore is not subject to the 90 days. Okay, sometimes actually some of the agency force, they might be confused. Hey, so this 90 day and the medical card 90 day, is it same? The answer is not same. So medical card, if go to Singapore more than 90 day, that medical card cannot reimburse anymore. Okay, the 90 day for the medical coverage is applicable for the all outside Malaysia lah. But this one accidental death for Singapore actually is no subject to 90 day. Okay, this one must be clear lah. So on board flight, yeah, we will pay 500%. TPD income is a 5% of a current sum assured for 10 years, and the infectious disease is 10,000. So additional sum assured, okay, just now we also have discussed already, is 25,000 increase added into the sum assured, and the additional sum assured is not subject to the insurance charge lah. Annual dividend, just now also have a touch a bit, is a 0.1% of average investment account value, and the no less benefit, yeah, just now we also have touched it, and the auto extension clause, you can see, in the event of a life insurance survive to the maturity at the end of an initial coverage term, so it will continue until age 100 without the evidence of a insurability actually is not required, right? So other than that, I think this one is a list of the infectious disease, okay? And the 90 days waiting period applicable for these infectious disease, all actually is clearly spelled out here lah. Okay, this one actually is a juvenile lien clause. Okay, and what fund actually is being chosen, and there's a basic regular premium and also regular top-up premium. Okay, I think just now I also have highlighted to you on this auto extension. Okay, so in the quotation they have somebody talk. Okay, so I try to mute first. Sekejap. Mute. Oh, all right. So now go for this auto extension. Okay, you can see the original term is 20 years. So for this one, premium payable is still 3,000. Okay, so here the Zurich Value Life premium with auto extension. Okay, coverage 20 years plus the auto extension up to the age at 70. So in this case, it's still showing 3,000. Here is NA not applicable payable from the age 41 to 100 means what? So this plan is by paying 3,000, they still can continue. Okay, they still can continue. And last, this one actually is allocation, premium allocation.
Yeah.
I
have a question.
For
the auto extension, okay, can you go for the auto extension?
This
so
one?
here they mentioned they're not applicable from age 41 to age 100, right? So what is the entry age? What is the entry age they are buying the policy? 10 years old.
For this plan, 30 days, just now we say the entry age.
So it's got different, right? It's not because this is not the same. Because if let's say the client is age of 35, okay, he bought for 20 years time, so he pay until 55. From 55 to 100, they have a charges over here because maybe the charges is varying. It's not the same, but correct. But it's not applicable means which means the insured maybe the age is 20 or 30 lah. I think so.
This one, you're right. This one actually the insured is very young, 20 only. But the insured is getting older. So here actually got a quite big amount already lah.
Yeah, okay. Right. But the amount is not same, It's
it is different.
Double of
it's different.
Premium.
Correct. So when come to that case, actually you can tell the customer this is option for you. Okay. If you want to do the auto extension, but you not necessarily have to follow that amount. Let's say the amount is 6,000. You not necessarily have to follow the 6,000. Okay, you also can use the 3,006 of 4,000. So, but this case actually we need to use a one policy calculator to calculate for them. Can or not? It's a Muru, is it? Can. Okay, can. So now next, I think the rest, this one actually is charges all these Okay, but mostly and the exclusion. But mostly actually, I think many of us, okay, I mute everyone first, because I muted already. Okay. So many of us, I think, normally actually we will show this table, okay, what is this cover? And next, the table. These are the table, correct or not? For this case, actually, I just choose the 10 pay, okay? 10 pay for the 3,000, okay, for the 500,000 coverage. So 10 pay is 30,000. This 30,000, actually, they can get the coverage from 500,000 to the 600,000. You can see the additional sum assured after 5 years, actually, they will increase, okay, until 20 years lah. And here, because of a young age, okay, this one is the age 20. So you can see when come to the reach 40, X. Okay, this is not granted, I need to tell. So what is different between the scenario X and Y? What is the main difference? X is the 2% protected, 2% protected return, very good. Y?
The
How
Y
about
is
Y?
5%.
Yeah,
5%.
5%. Thank you. It's a 5%. So it's based on the projected 5%. Okay, the 20-year actually they still have a 27,000. Okay, it's quite high lah. Just pay for 10 years, 30,000, and 20-year is 27,000. But anyhow, here I need to re-highlight again. For this plan, actually we sell. It's good actually we sell on the protection For you can see, just pay the 3,000. If anything happen we will pay the 500,000 already. And kalau TBD, we will pay the 500,000 plus the 25,000 for the next 5 years. Because of a young age, that's why the insurance charge is lesser. Okay, so you can see the insurance charge for this both side, basic X and Y also will be different. Y will be lower. Why? Y actually will be cheaper. Some of you use the handphone, tak boleh nampak. Letak besar sikit. The insurance charge. For Y will be lesser. Why? The insurance charge here. We look at the 10 years. Let's say at the 10 year, ini 516, ini 513. Because the cash value is slightly higher. So that's why the Y will be, this Y will be lesser lah. The sum at risk, we calculate based on the sum at risk. So the rest actually, I think this one just now I've discussed already. Okay, the bottom one actually is talk about the fund, the risk and also the fund performance, all this, right? I think this one is quite standard already right? Now I think we will move on to the last part, which is on the summary, on this today, on the today topic.
Yeah, I have a question.
Yeah. Mm-hmm.
Okay, just now you go for the quotation, right? You show me the cash value X and Y.
Yeah.
Okay, let's say the client. Okay, for example, just now
I show them
around 15,000. Okay, client want to withdraw 10,000 from the cash value before they reach for the maturity. So
okay,
after the other 10 years, you don't need to pay, correct? Because you pay in 10 years. So the next 10 years, you don't need to pay lah. Correct. So after 10 years, the client withdraw the 10,000 from the cash value. So what will happen in other 10 years? So is it the withdraw money he need to pay back, or they will deduct from the submission, or it will deduct from the maturity benefit?
Okay, so refer to this case. Let's say just now, the question you asked is this one. Actually, very good question. Okay, after 10 years, what happened?
Okay, they pay 10 years, right?
They pay 10 years, 10 years, 30,000, So inside got the 25,000. We just want to withdraw the 10,000.
Okay, we take on 70 year, 70 is 15,000, 836. Okay, the client want to withdraw 10,000. So 5,000 he remain in the fund. So another three years he'll pay the premium. So what will happen in another 10 years and after they reach the maturity? So let's say the client want to continue until age of 100. So what will happen for the withdrawal for the 10,000?
Okay, so first of all, we discuss about the 10,000 withdrawal first lah. So when they want to withdraw the 10,000 Mr. Just now who is talking
Kumaran, yeah.
Mr. Kumaran, if they want to withdraw 10,000 what should we do as a wealth planner? What are the things actually we need to do, Mr. Kumaran? That's the first thing I would like to. So in order to help customer to perform the partial withdrawal for 10,000, what are the things we need to do?
OPC lah.
Yeah, well, we need to go to the as we say OPC and Mr. Kumaran said OPC lah. So we need to use the OPC and generate the sustainability test, correct or not? Okay. So from from that OPC actually we indicate to the customer already how long the policy can sustain after the partial withdrawal done. Okay, so that is the first thing we have to take note. So definitely after we withdraw the 10,000, the sustainability period will be shorter. Correct or not? Because originally company are based on this 15,000, is it just now? The entire premium to calculate expect the policy can sustain until 20 years. But since in between got the withdrawal already, so it definitely actually will be impact on the sustainability period of the policy. Right. So now go to the question number 2. If a customer want to continue to cover until age 100, okay, the answer can or not? The answer is a can because got the auto extension. So during the after 20 years, okay, so company actually will have we can use the to calculate use this OPC to calculate how much actually they need to pay to in order for him to continue until age 100. But in between, let's say before the initial term, okay, let's say this one, we still use this as an example, Mr. Kumaran and the rest. This one jikalau after 10 years already. Okay, I use a 10 years period already fully paid 30,000. But at the 10 year, you withdraw 10,000. Okay, can? So after withdraw the 10,000, can see the 25,000. Okay, I highlighted here. Okay, after withdraw 10,000, only 15,000. So 15,000 can last until next 10 years or not?
Cannot. Because of the cost of insurance charges.
Yeah, might not cover on this cost of insurance charges. So in between, actually, the policy might lapse if they didn't do anything. But the question is 11 to 20 years sudah tak ada premium boleh bayar. How? So they have to perform the M-top . They need to perform the M-top . M-top actually is an irregular top-up. Okay, minimum is 500 per 500 per top up. Okay, can all right.
Is it 5
okay, so let's say that the client will withdraw for 10,000 on 10 years. So the remain another 15,000. So we advise the client to do the single premium top up for every year or one time.
Single premium top up, actually we can advise them so maybe no need to be very frequent so you can use a one policy calculator to calculate and also depend on the customer affordability okay, so if a customer, if they afford, so we can ask them to advise means they can put the lump sum top up higher because for each top up they are required, they have a top up fee 25 ringgit. Okay, they have a 25 ringgit.
If let's say after the 10th years, I advise my client, so every year advise him to top up minimum 1,000 ringgit in his investment fund. If let's say the client is top up until the maturity for example, until age of 60 so every year you top up because he pay for 10 years only after 10 years no need to pay and you withdraw the cash also. from the fund. And I advise the customer, okay, every year you top up 1,000 for the investment fund. Is this a policy sustained until the age of 70 or until the maturity benefit, or still have any issue? Let's say the fund value is low or the policy may be go lapse. So you got any issue?
They still have a depend on the other factors. We know that the investment link, okay, to determine the sustainability of the policy. This one is talk about the investment link plan. To determine the sustainability of a policy, so we not only refer to the insurance charge, okay, but at the same time we also have to see how long means how much the customer pay the premium and how good is the fund performance. Okay, so all this actually will determine how long the policy can sustain. But anyhow, okay, as I mentioned in this session, customer every year will receive the sustainability statement, ILP sustainability statement in the early of a year, so they can check, means from that statement actually will indicate this policy expected can last for how long. Okay, so ini macam medical checkup lah, but this one is an invest policy health checkup. Okay, every year the company actually will send that letter to the customer and indicate how long this policy can sustain. Okay, can like example, Mr. Kumaran, if you ask the customer, advise the customer to save, means top up 1,000. Okay, if the total insurance charge is less than the 1,000, so definitely actually it will improve the sustainability period. Means the sustainability period could be longer, right? So ini kalau kita mau tahu, you also can use a one policy calculator to calculate lah. Oh, okay. Alright. So now,
thank you.
Okay, now I think it's good because this one actually will be involved for the all applicable for the all insurance policy lah. Okay, so as a summary for today, okay, Zurich Value Life Premier Enhancement, I think talk about the contest. Thank you very much, Dini, to share to all in the so detail on that campaign. So that campaign I won't talk again already lah. If you want to know, always can choose refer to your ADH, or for FA you can refer to Yongnam, okay, and others. So this actually is just to highlight, reiterate again on the Zurich Value Life Premier Enhancement. So start from the 1st of January, the non-met limit for the 16 to 50 years old already increased from 4 mil to 5 mil. That's the first part. And the second, okay, is the non-met limit for the age 51 to 60 is increased from the 1.3 mil to 3 million. Okay, point number 4, for non-financial underwriting limit for the non-professional actually increased from 3 million to 4 million. And the TPD limit also increased to 10 mil. So this actually is a plus point about this.